online training program is an initiative for UGC net coaching undertaken by the Commerce Club, Department of Commerce, University of Kerala for providing online guidance and coaching to those who are wish to crack UGC net with JRF in this work situation. On 1st August, our online net coaching was inaugurated, and the inauguration was done by Professor Dr. Gabriel Simon Thattil, and the session was blessed with the presence of our beloved Dr. Rizia ma'am and Dr. Biju sir. Along with the blessings of Almighty, today we have the first session on the topic income tax and corporate tax planning, which will be taken by Professor Dr. Gabriel Simon Thattil sir. Myself, Nilayas Nair, MPhil Scholar, Department of Commerce, University of Kerala, and today I am entrusted with the duty of invite you all to this event. First of all, I welcome our resource person, Professor Dr. Gabriel Simon Thattil, our beloved head, Department of Commerce, School of Business Management and Legal Studies, and the Director, IQAC, University of Kerala. Some of us know him and some do not. So, I use this opportunity to introduce him to others. Dr. Gabriel Simon Thattil is a professor in commerce, who was awarded PhD in the Faculty of Commerce from the University of Calicut in 1996 for the thesis titled A Study on the State of the Art of Human Resource Management in the Industrial Sector of Kerala. He has more than 28 years of teaching experience, serving as professor since February 2010. He is an approved research guide of the University of Kerala, Trivandrum, both in Faculty of Commerce and in the Faculty of Management Studies. He has authored 3 books, have 42 research publications, 7 study materials for courses, etc. He has assisted 4 universities in their pre-NAC accreditation process, acted as academic auditor for Mahatma Gandhi University, is the coordinator for the flagship career guidance scheme for school children, My Career, My Dream. And he is currently serving as the General Secretary of Indian Accounting Association, which has 50 branches across the country, and also as the Director, IQAC, University of Kerala, and served as the coordinator for several research projects and consultancies across universities. He is a life member in Indian Accounting Association, All India Commerce Association, New Delhi, and governing board member at Center for Development Studies, etc. There is a lot to be said about him, but due to time constraint, I am limiting my words here. And I consider it a great honor to welcome you, sir. So, on behalf of me and the Commerce Club, Department of Commerce, University of Kerala, I welcome you, sir, to handle this session.
Okay, thank you. Thank you, Nila, so much.
It's my pleasure. Thank you, sir. And it's my pleasure and privilege to welcome you all and have a nice evening. Thank you. Over to you, sir.
Thank you. Very good evening to one and all. Because we are just having our minimum appropriate time for the session, I won't take much, without much introduction. Let us directly start off with the presentation. Yeah, is the screen visible?
Yes, sir.
It is. Okay. So good evening once again and welcome back to this net session. The first, the unit number 10 that you have for your net examination is on income tax law as well as tax planning. Now it has got 4 subdivisions, and basically what we are going to cover in these 4 subdivisions is the first part is basic concepts, then you have the residential status, then you have exempted income, agriculture income, income under different heads, deductions under heads of income. Up to this is 2 units. Then you have deductions from the gross total income. It is GTI, not CTI. And you have assessment of individuals coming up. And then you have the corporate assessment, which is a corporate assessment, as well as tax planning and management, which is 3 and 4. So if you look at the content, it is pretty large, but then we have to see how we have to go about when we are looking at it from the MCQ perspective. So today I'm not sure how much I can cover, but if we leave something uncovered, perhaps we should have 1 or 2 more sessions in order to ensure that we are able to reach out with the good number of units in this. So at the most, we can look at part A and B. I'll try to go up to some of, at least half of this heads or half of the content today. That means we'll basically discuss basic concepts, residential status, tax incidents, exempted agriculture income, and income under different heads and deductions under the heads of income. So this is basically what we're trying to do. Headwise, again, we'll come back when we discuss set off, carry forward, and things like that, because there are a large number of MCQs which are basically oriented onto the basic concepts. So basic concepts is what we are trying to look at in a big way today. Now, I'll quickly draw your attention or make a recap of what we were looking in terms of tips and how that becomes more important when we are talking about income tax law and practice. You're all looking at MCQs, and obviously, when I'm talking about this content, you will have to look at how you would become or how you would enable yourselves to be smart in approaching the MCQs with the content. So this is what we are basically trying to cover, because basically when you look at the content, it will all sound very simple, but analytically or inferentially, how these questions can be twisted and how those options can be addressed is what we actually need to look into. So I'm starting with some basic concepts on which we'll go a bit fast. One is assessment year, which all of you know, which is given as a basic concept there. Now, you are not going to write descriptive statements here, so you're going to be very precise on it. It's a period of 12 months. It starts from 1st April in 1 year, and it ends on 31st March in the next year. So basically, it's the financial year. So MCQs can be, how does assessment year match with the financial year? In the current year, how the taxations can be. So the current assessment year is 21-22, which has started from the 1st of March 21 and which will go up to 31st of, which has started with the 1st of April 2021 and which will go up to 31st March 2022. So the current assessment year is 1st April 21 to 31st March 22, which is very simple. And then I'll tell you what is going to be a bit twisted over there. And the next concept will be the previous year. So the previous year is basically a period of 12 months, which is just preceding the assessment year. So if you say assessment year is 21-22, previous year will be 20-21 and just preceding 12 months. So for the assessment year 21-22, the previous year will start on 1st April 20 and end on the 31st of March 21. So that's the previous year. Now, what is more important is what we are seeing after that. Income earned in the previous year is taxed in the assessment year. So you will be asked questions in this form. Which is the year of earning? The year of earning is always the previous year, and the year of taxation is the assessment year. So for the year 21-22, for this assessment year, you will be filing your returns. That means your taxation is happening in terms of what happened in the year 2021. So year of earning is 2021, and the year of taxation is 21-22. If your year of earning is 21-22, its taxation will be in the year 22-23. So this is one thing which you should keep in mind. And we have something in India, which is the uniform previous year. It was not so until 89-90. So remember that it was only from the year 1989-1990 that we moved on into the uniform previous year. So across India, currently, we always have assessment year to be 12 months, which is the financial year starting from 1st April in 1 year and ending with the 31st of March in the next year. And throughout the country, we have a system where the previous year is just preceding 12 months. But this started only in 89-90, and before that, we never had uniform previous year. Now, what does that mean? This means that before 1989-90, the previous year was the accounting year which ended in the 12-month period preceding the assessment year. Once again, I'm repeating, it was the accounting year. For different SSCs, they'll have different accounting years. For some, it will be the calendar year. For some, it was 1st July to 30th June. So you could have different accounting years. So you take the accounting year and you take preceding 12 months from the assessment year, and the accounting year which ends in that preceding 12 months was the previous year. So say, for example, suppose a firm follows, or suppose an individual follows the calendar year as the accounting year. So calendar year, you always know, it starts from 1st January and ends in 31st of December. So imagine the current assessment year. The current assessment year is 21-22. And 12 months preceding that is 1st April 2020 to 31st March 21. So you take the 12 months preceding, and in that 12 months preceding, the accounting year is 1st January 20 to 31st December 20. So that was the previous year. Now for some other firm, if they are following the financial year, they'll have the financial year as their previous year. And for another firm, if they are following 1st July to 30th June, that will be their previous year. So previous year could vary according to the accounting year. And you take the accounting year which precedes the assessment year and you fix the previous year. So this was a situation where the previous year used to vary. Anyway, after 89-90, I remember the year because that was the year when we had a uniform previous year. From this year onwards, 1989-90, we always have previous year, which is the financial year immediately preceding the assessment year. So for it is uniform for all forms of SSC, and it is uniform across the country. So these are the basic concepts of assessment year and previous year. Now we go on to charge of tax under section 4. These are some basic concepts which we can quickly go through. One, we have an annual tax. This is an annual tax. It's not a monthly tax or a weekly tax. It's an annual tax which you pay for assessment year. Number 2, this annual tax is actually a rate. The rates for the taxation is fixed by the Finance Act. This was once asked in the your MCQ question, which is where does the income tax rates get fixed? The income tax rates are never mentioned in the Income Tax Act. It's mentioned in the Finance Act. And the Finance Act gives these rates which get tabled on the 1st of April of every year. And it is this rate which is given by the Finance Act which gives you the rate of taxation. It's not given by the Income Tax Act. Now, suppose it's not given in the Parliament. The Finance Act is not given in the Parliament on the 1st of April, again for your MCQ. Then what will be the option that is left with the SSC? You can take the rates which were there in the previous year. So this, suppose in 1st April 2021, the Finance Act is not giving the rate, then the SSC can go by the previous year's rate or the rate which is to be introduced and take whichever is beneficial. So it's not always that you go by the previous year's rate. Keep that in mind. Again, for your MCQ, you have the option. The SSC has got an option to follow the upcoming rate or the previous rate, whichever is beneficial for him in terms of the total taxation that comes up for him. But this is only in the case where the rates have not been specified. If the rates are specified, the rate of tax will be as given in the Finance Act, and remember, it is not the Income Tax Act. And again, your tax has to be paid on the total income. Now, there is no distinction whether the income comes from legal or an illegal source. But obviously, there are no chances of income from illegal sources being accounted for. Because the Income Tax Act says you must record and give all your income, including income which you have derived from illegal source. Suppose you get income from theft, or income from smuggling, or income from dacoit, some kind of smuggling of arms and things like that. These are all income which you get through illegal acts. So you must show the total income. But the problem here is, if you show all these incomes under the Income Tax Act, your total income might be right. But under some other act, maybe the CRPC or some other act, you might get, you are likely to be penalized or punished. So on that count, normally there is no chance of there being illegal income being accounted for. But the income tax says it is total income, which is legal as well as illegal. Tax is on every person. So here there is something which you need to keep in mind. You need to understand the concept of person, the concept of individual, and the concept of SSC. Now, person is a wider term and it includes individuals, but a person has with it an artificial person also. So person can be an individual, person can be a firm, person can be an association of person, it could be a body of individuals, it could be a corporate entity, it could be a local authority, it could be an artificial person. So one among the person is an individual. So person is different from individual. Individual is a natural living human being. Clear? So there is taxation of individuals and there is taxation of other persons. In your curriculum, I found you have taxation of individuals under the heads of income, and you have taxation of corporates. So these two things are included. So we are looking, whenever we say SSC, we are talking about an SSC to be a person, not as that person can be an individual, a firm, an AOP or BOI, or even a corporate. So we are talking about taxation for a person. And SSC means, SSC is somebody who is liable to pay tax under the Income Tax Act, or against whom some proceedings have been taken under the Income Tax Act. So it's not always essential that you should be liable to pay tax. So imagine, suppose your income is very low and you believe that you are below the taxable limits. So you do not file a return. But if an assessing officer feels that you're not disclosing your income, and maybe a best judgment assessment or some charge has been imposed against you, and after that subsequently you might prove that you have less income, or you might be caught for having high income, but a proceedings has been initiated. If the income tax officer or the assessing officer initiates a proceeding under law against you for taxation, then you become an SSC. Even if your income is below the taxable limit, or you have not filed a return, or you're not liable to pay tax. So who is an SSC? Primarily a person liable to pay tax under the Income Tax Act. It does not, that does not end there. Plus, that's why I'm saying your MCQ, plus any person against whom some proceedings under the Income Tax Act has been initiated. So either you are liable to pay tax and you do that, or you are not paying tax, but some proceedings have been initiated against you. So in these two contexts, you become an SSC, and a person can be an artificial entity as well. So this is with regard to the provisions for charge of tax under Section 4. Now, income. This is very important. Income under Section 224. It is inclusive. Most important thing for your MCQ, it is inclusive, it's not exclusive. When you say inclusive, it means that under the definition of income, there are certain listed items which will call for taxation. And all those things together, all those things included together, or all those things put together will become what we call income. And this comes under entry. I'm giving you this again for your objective type. What is most important there is the 7th schedule of the Constitution, entry 82, list 1 of 7th schedule of the Constitution. That is what gives the list of items which are put, and under that there are certain things which are said to be exempted. For example, agriculture income is exempted. Now, if you look at the definition part, it talks about this in this form: a periodic product of one's work. So one's work is one source of income, or it could be one's business, or it could be something which comes from investment, which is yet another source, or it could come from land or animals. So periodic product of all these things. There is also another way of looking at it. It is an increase in wealth of a person during a stated period of time. So this is how the definition goes. So we need to know that it is inclusive. It is as given in a particular schedule, and this is how it comes. And there are certain things which are exempted from this. And it is by and large on an accrual basis. So that is very, very important. You have a receipt basis and an accrual basis, which you see in your accounting part. It is not only those incomes that you receive that will make you liable to tax. It's also those income which you are liable to receive or which is due to the assessee, which will make you liable for tax. So say if I am entitled to get salary, and I do not receive that salary, I'm supposed to pay tax for that salary unless I surrender the salary to the government. So also, if I am entitled to get income from house property, and maybe I don't give my house property on rent, or I give it at a lower rent than what is entitled to me, even then I'm entitled to pay tax on a due basis, which you'll see when we try and look at the different heads of income. So it's accrual that is more important, the accrual concept, similar to what you have in terms of your accounting concepts. There is a link between this in terms of profits and gains from business and profession, perhaps one part of which we'll discuss today, but whole thing we cannot discuss today. In accounting, what we discuss and what we see, I'll put that towards the end after looking at the basic concepts which we need to cover for today's session. Again, basic concepts. Keep this in mind. This is again a question which was asked. There is a concept called diversion of income and another concept called application of income. So what do you mean by this? Diversion actually means income received by a person other than the person who is entitled for it, and the recipient later diverts the same under a title. Now look at this, I'm once again repeating it. Income received by a person other than a person who is entitled for it. That means a person gets some income, but that person is not fully entitled for that income in terms of a title. By title, that income should have gone to somebody else. And the recipient who gets it subsequently diverts or transfers it to the person who has a title for it. So very simply, it is like this. Somebody gets an income for which that person is not entitled. He receives it and later transfers it to the person who is entitled to receive it. This is called diversion of income. So what does that mean? I'll just give it through an example. And this happens in several cases. Suppose I make a joint publication in a journal for which the publisher gives me some income. And they fix the income as 20,000 rupees for the publication. I hope I've made myself clear. You have 20,000 rupees for this publication. Now, this publication is not my work. It is my work along with a co-author. So myself and the co-author, together we publish, and we are told by the publisher that we are going to get an income of rupees 20,000 for this publication. So I tell my co-author that we have done this together, so I will not take this amount in full. I will share it with you, and you are entitled to get half of it because you are the co-author for it. So this is how the title goes. The income that comes will be shared between the two authors on a 50-50 basis. So I'm telling him I'll give you 10,000, I'll take 10,000, and this is how the sharing has to go. But the publisher will normally give it only to the first author. Now, when I'm getting 20,000, I know that I'm not entitled to 20,000. I'm entitled only to 10,000. And I've also agreed to transfer the other 20,000 to my co-author. Now, I receive this 20,000, knowing well that I'm not entitled for 20,000. I'm entitled only for 10,000, and that there is a co-author who's entitled for the remaining 10,000. I receive the 20,000 and I give this 10,000 to my co-author. This is called diversion of income. I'm diverting income because the person who gets it is not entitled to it, and there is somebody who is actually entitled to it. And there is also an agreement that this is how it should be shared. So you get it together and you share it with the person who is entitled. Now look at the next sentence, what I've given over there. Tax is payable by the person to whom it is diverted. What is diverted is not taxable in the hands of the person who gets it. In the example that I gave, I received 20,000. But if there is a diversion of 10,000, even though I received 20,000, I'll be taxable only for 10,000. And for the remaining 10,000, person to whom it is diverted, my co-author, he will be taxed. Clear? So what is diversion? So this will come for your MCQ, if at all it comes in for MCQ, it will be through examples. So if there is a prior agreement, a prior title on sharing, and one person gets the full amount, and subsequently he shares based on the title, then he will be taxed only for his part, and what he diverted will be taxed in the hands of the person to whom it is diverted. This is called diversion of income. So this is different from application of income. Application of income means, again, one person gets the income, but there is no prior agreement on sharing or there is no prior title. After getting the income, for which he is entitled, there is no other person who is entitled to that, but that person says, after getting that, subsequently he used it for different purpose. I'm saying that I got 20,000, but I paid 10,000 to my assistant who's my salaried employee. Or I paid 10,000 for some charges and therefore I have only 10,000 left with me. But this is not based on a prior title, and I'm just saying that subsequently I spend some amount for different purposes. In that case, there is application of income. There is no diversion of income, and tax is payable by the person who originally gets the income. So if I get 20,000 and I'm saying 10,000 I gave as salary to my assistant, that 10,000 cannot be adjusted because it's application. It's application of income. It's not diversion. So I'll have to pay on full. I hope you have understood the concept. So as far as your MCQ is concerned, in application of income, the income which has been diverted or transferred for other purposes will be taxable. The total income will be taxable on the person who originally gets the income. There is no claim that is possible for diversion that has taken place. Whereas in the case of diversion, the diverted part will be taxable only in the hands of the person to whom it is diverted. But the concept must be clear. You have to decide whether it is diversion or application. Diversion comes only when the recipient diverts it under a title, and he says that I'm not entitled to get this full amount. I'm taking it in full, but I'll be subsequently giving it as per a title deed for it or a title agreement to it. That is what is happening here. In case of application of money, the case which went off was in fact a case from Kerala, which went up to the Supreme Court in terms of a priest. And what happens in many charitable institutions and the priests and nuns and all, they work for institutions, they get salary. But based on their vocation that they have taken up in the form of priesthood or nuns and all, they have to give their entire salary for their order or their charitable institutions, and they live on a very small amount. But this is not what the court said was, it is not actually a diversion, but it is just they are giving their amount for some other purpose. So it's application of money. So this is the very important concept of diversion as well as application of income. Now, again, there is deferred income. Deferred income is also taxable. So diversion, application. So when you are diverting, the diverted part will be taxed only in the hands of the person to whom it is diverted. But when there is application, full amount will be taxed in the person who gets the original amount. Deferred income is also taxable. What do you mean by deferred income? The income which is due on a particular day, I'm saying that I will take it only after 6 months, or I'll take it only in the next year. So I'm just deferring that income. I'm postponing the benefit that I'm getting to a future period, but it is due to me in a particular day. So I can't say that I didn't get it, I deferred it to another day. another year. So this year I didn't get it. This year you are entitled to get it. So even if you defer it to another period, it will be taxable. Pin money is sorry. There's a small spelling mistake there. Pin money is not. It is taxable. Pin money is not. What is this pin money? Pin money is something like pocket money, which is given generally by a husband to the wife for maybe some dress or some expenses to cook and all. So it's some small pocket money which is given in that form, and that is held as something which is a petty money for the close associate, husband giving to the wife, and it is not taxable. Source of income again need not exist in the assessment year. Income will be there. If income is there in the assessment year, it is taxable. That source need not be in existence. Say, for example, there was a business in the year 2015, and subsequently that business got closed down. But from something which was pending, some bad debt which existed when the business was running, some person gives me some income which I realized. This income comes in 21-22. But the business ceased to exist from 2015. Now, in that case, that income is also taxable, even though the source is not existing in the assessment year. So we don't look whether the source is existing or not. Again, income can be in cash, or in kind, which we are going to see you see it in a big way in salary. What you get in cash will be your basics, your basic pay, and your allowances. There are many things which you get in kind. And when you get it in cash, it will be in the form of actual money value. If you get it in kind, like you're getting a car, you're getting a house, you're getting perquisites, then you have to value it as per the income tax rule. So income can be in cash or in kind. Now, the concept of GTI under section 14, GTI stands for the gross total income. Your income is earned under these heads, which is very simple, so I'm not spending much time. The 5 heads: the salary, income from house property, profits and gains from business and profession, capital gains, and income from other sources. The 5th head is a residual head, which is called income from other sources. Now, in all these cases, we have to look at some basic concepts. I'll just quickly cover the basic concepts which are important here. Under salary, what is important is some basic concepts relating to salary, which turn out to be important. Is there are certain conditions if you want to call something as salary. That is, most important condition is there need to be an employer-employee relationship. So it's not the word that is important. The word, if you look at the word, what an MP gets is called salary. What a partner gets salary from the firm, but a partner is not an employee of the firm. So only what you get as income in terms of employer-employee relationship will come there. And it is also what is due that becomes taxable over there. Rest of it, there are deductions and all, we'll see that later. Similarly, when you say income from house property, it is there is a fair value for that income. And we look at the fair value, the market value, what is due and what you get. And if you earn more than what is due, that will be taxable. But if you earn less than what is due, you look at what is due and make that taxable. So we look at that again when you come to that particular head. Again, profits and gains from business and profession, we look at it in 2 forms, business and profession. Here there are 2 basic things which you need to keep in mind. Normally, as students of commerce and business, our concept of business and concept of profession as we learn it in accounting or in business studies, many things are similar, but there is a bit of a difference in that. If you look at the definition of business, it is definitely there'll be a lot of theoretical part like state of being busy and all that. If you leave that apart, the 2 essential concepts in business is profit motive and possibility of loss. So profit, I'm talking about the basic structure of business. So there is profit motive, there is possibility of loss, which we call risk, and then you call the third important item is continuity. So if I do something just with one transaction and I stop it, The theoretical part of your business studies or your business management will tell you that this is not business because I'm doing an isolated transaction. There's no continuity in it. Similarly, if I do something in which I am 100% sure that I will make a profit, then there is no possibility of loss. That means there is no risk in that. And I'm doing something with not just with motive, but I'm sure to get a profit. But when it comes to taxation, in profits and gains from business and profession, we need not always look into this element of continuity. And it is all not also necessary that everything that we call as, if there is an income derived from that, beyond the motive, we look at the income. So that is something which stands out over there. The other concept of capital expenditure, revenue expenditure, capital receipts, and revenue receipts stand here also. And of that, the most important concept that you need to keep in mind is how do you categorize something to be a capital expenditure and something to be a revenue expenditure, because that is very important when you compute business income for taxation. Only that which can be attributed as revenue can be put into your profit and loss account. So that, how do you decide that? Now, in your +2 days or in your BCom days, we classify that big expenditure to be capital expenditure, small expenditure to be revenue expenditure, day-to-day operations revenue, purchase of land, building, plant, machinery, furniture to be capital, long-term to be capital, short-term to be revenue. So we have seen all these kinds of definitions and concepts earlier. Now, we need to have a clarity which is taken into account when you look at taxation, because large and small we cannot always say. For a very small petty shop, what we call something like a Thattil and all, what is large for them might be very small for a multinational corporation. And what is long-term, what is short-term, what is day-to-day administration and or operating expense, all can have some element of relativity in it. So what the Income Tax Act says, or for that matter, even accounting says, if you want to call something as an expense, if you want to call it as an expense, then it is different from a loss. And an expense is essentially incurred with an anticipated benefit. So if you want to call something as an expense in business, remember there should be an anticipated benefit from it. Otherwise, we don't call it an expense. Say, for example, if you pay salary, you must get a person's service. If you pay rent, you must be able to use a building. So it is all with an anticipated benefit. Now, the test for capital and revenue comes in terms of when that benefit expires. When you have incurred an amount or you have spent an amount in anticipation of a benefit, when does that benefit come? Is it within the accounting period or beyond the accounting period? That is how it actually goes. The test is that. So if I pay salary, it is for the service of 1 month, or if I pay daily wages, it will be for the service of 1 day. So it does not go beyond the accounting year. But if you purchase land, you use it for many years to come. You purchase building, you use it for many years to come. So expense has got two intrinsic features. Number one, it is deliberately incurred, whereas a loss happens accidentally. It is a coincidence, loss by fire, loss by theft, loss of stock. This is deliberate. And in a loss, there is no anticipated benefit. Loss by fire, we never thought it would happen. It happened, and there is no anticipation of any benefit from it. Expense is deliberately incurred, and there's an anticipated benefit. If the benefit goes beyond 1 accounting year, then you put that as capital, and the amount that is spent on that should not be part of the profit and loss account in terms of an expense. So you cannot put it in the profit and loss account, even if you call it by revenue. That is very important. That is what you have to look into your MCQ. Say, for example, a cinema theater. These are all actual cases which you see in taxation. A cinema theater says we are doing annual maintenance, which looks like a revenue expense because it's to maintain your assets. But in the process, if they convert their non-AC theater to an AC theater, or they make a drastic change in the ambience of the theater and thereby increase the revenue that comes from selling of tickets, then the income tax officer will say this is not maintenance because your long-term income generating capacity has changed, even though you're calling it as repairs and maintenance. So this is what I'm trying to talk about. So there, the test is when you have spent something, within what period will the expense go? And that is what is actually looked into. Another major difference that you see when you look into your accounting concept versus profits and gains from business and profession is the concept of depreciation. Depreciation is provided on the basis of, as per accounting concept, you say that it is initial cost minus scrap divided by life. Suppose an asset costs 10 lakh rupees, its life is 10 years, scrap is 1 lakh, then we will say 10 lakh minus 1 lakh, 9 lakh, and divided by 10, 90,000. So 90,000 every year you go on depreciating. But in the income tax, this is an allowance. And the written down value method is followed and the rates are prescribed, and that is what you can claim from year one. It is not based on this philosophy of cost minus scrap divided by life. So some basic differences exist, as I said, continuity, profit motive, and the way you look at capital and expenditure is the same in business as well as, in your theoretical accounting or business and in taxation. Same with capital gains. It talks about the gain that you get from transferring assets and how you actually reinvest those assets. And what does not come under the 4 heads will be put into the 5th head, which is income from other sources. Now, once you get your gross total income, you need to understand before we start with the heads, you need to understand the structure of total income. And this is that structure. Look at this. You will find under this, each head, there is an income that comes. In salary, it is basic salary, your allowances, and your perquisites. Then there are some, from that you get the gross salary. Then there are some deductions which come under section 16. When those deductions are deducted, you get taxable salary. Then again, income from house property, it's based on the adjusted net value. Then there are some deductions which come under the head income from house property under section 24. Now you get taxable income from house property. Again, similarly, you go to the 3rd head, you get income from business and profession. Something interesting that you will see over there is, from this, you add expenses debited but not allowable. That means these expenses, which I said earlier, they have been put into the profit and loss account and deducted by the person, by the assessee. But the income tax department feels that it is not an expense. It's not a revenue expense. So they are added back. And it can also, other thing can also happen. Some expenses which the income tax department feels you could have claimed and you have not claimed. So you deduct that. Less expenses which are not actually deducted. So you can actually claim that. And Okay, you can claim that and you make adjustments for that. Similarly, there are some incomes credited, but they are not incomes. So you deduct that. So that in fact, you're making adjustments for those values, and then you arrive at the taxable profits and gains from business and profession. Then you go to your capital gains. Again, under that, there are some deductions. Section 54, you get your taxable capital gains. Income from other source, some deductions under section 57. After getting all this, you make adjustments for set off and carry forward. This concept means if you have a loss in one source and an income in another source, you can adjust this. If you have a loss in one head and an income in another head, you can set it off. You can adjust this. So you make this and you get your gross total income. From this, you make deductions under section 80 and you get your taxable total income. Now, what is the basic point that you need to understand here? That is what I was trying to put across through these 2 slides. you will see here two forms of deductions. One is head specific deduction. Say for instance, under section 16, there are deductions in the form of standard deduction or professional tax, which you can claim only when you have salary income. Under section 24, house property, there is deduction for interest on residential property, which you can claim only if you have income from house property. Under depreciation, you can claim only when you have business income. Similarly, you can claim under section 54 deductions only if you have capital gains. So these are head specific deductions. After making the head specific deductions, you arrive at the taxable part for each head. From salary, when you deduct your standard deduction, you get taxable salary. From house property, when you deduct your interest, you get taxable house property. From capital gains, when you make deductions under section 54, you get your taxable capital gains. Then you make your set off and carry forward. Now what you get is a gross total income. From this, you have got certain deductions which is based on the total income and it is not based on the head specific income. And these deductions, again for your MCQ, are based on two factors. One, the investment which contributes to the economic development of the nation. When you subscribe to mutual funds, when you subscribe to life insurance products, when you invest in banks, it directly or indirectly goes to enhancing the economic wealth of the nation. So that way, it is an incentive for you to do this. Similarly, you can contribute towards intellectual property, or you can contribute to environment protection or care for the society in terms of caring for the differently able. So encouraging economic social well-being is what is actually put here under section 80. And by virtue of using this section, by virtue of putting something into life insurance, provident fund, post office savings, or for creation of infrastructure, or for development of backward districts or backward areas in the country, or for taking care of the differently able, you are spending something on the social, economic, or physical infrastructure of the nation. And through this, you are allowed, through a spending on this, you are allowed to reduce your tax. This is what happens under section 80. And that is why it is called tax planning. And in this section 80, there are certain sections, say like 80C, which is available only in the case of individuals. And there are certain other sections which are available to corporates, which are available to all when we talk about donations and things like that. So we can use this and reduce tax. And that is what actually we talk about tax planning. And in your MCQ, we need to talk about tax planning for individuals and tax planning for corporates, how it is possible using the loopholes or using the provisions which exist within the law for this purpose. Now, again, coming out with the basic concepts, when you take your total income, we come across two concepts again, rounding of income and rounding of tax. Rounding of income is discussed in section 288A and the other one in 288B. In both the cases, rounding means whatever you get as your total income will be rounded off to the nearest multiple of 10. Suppose you get 4,83,214. 214, the last digit is 4. This will be rounded up. So you'll never have a last digit 1 to 9. You'll have a last digit always 0. Nearest multiple of 10. So if it is 5 and above, it will be rounded upward. Below, it will be rounded downward. Same in the case of the tax. After applying the tax rate, you will get this in the same form. So this is rounding of income and rounding of tax. Now, exempted income and deduction. Keep this in mind. Again, this is a concept which comes in a hidden form in your MCQ. How exempted income becomes different from a deduction. Now, income which is not considered while computing income is what we call exemption. It is not at all considered when you take your, say, for example, the income that you get from agriculture. It's not at all taken into account when you compare your total income. So it's exempted. Now, this is, I think, something which most of you perhaps can easily understand. But what comes as a computational part when it comes to your MCQ for the net is some exemptions will be given to you and some incomes will be given to you. And how do you actually take the whole thing together? Now, what is important here, that's what I've given in the next line. Exemptions cannot exceed income, whereas deductions can exceed income. So that is very important. So suppose I make a loss in one business and I make a profit in another business. Now, this loss I can deduct from the income that I have earned from another business. It's a deduction. Suppose I have taken interest in building a home, and my income from that house property is very low, and I am paying a huge interest on the loan which I have borrowed for that particular home. In this case, this interest on housing loan is a deduction. So if I have an income of maybe 1 lakh, and if the interest on the loan is 2 lakh, from 1 lakh I can deduct 2 lakh, I can show minus 1 lakh, which means loss from house property 1 lakh. So by virtue of deduction, this is what do you call, in nutshell, what you need to keep in mind. But by virtue of a deduction, you can have a loss, you can have a minus figure. But by virtue of an exemption, suppose I'm saying that I have only from business, my business income is say 1 lakh rupees, and I have an exempted income which comes to a particular figure 3 lakh. So I cannot adjust this and say 2 lakh profit. So your exemption you can claim only up to the income that you have. An exemption is never considered while computing income, and it does not exceed income, while deduction is something which is initially considered and then it is deducted. So for example, when you say entertainment allowance, you take it along with salary and then you reduce it. So it's a deduction. It's a deduction. In one part of it, you can claim as what can look like an exemption. So what I'm trying to say here is keep these two things in mind. Exemption means it's not considered while computing and it cannot exceed income. Deduction is reduced from the income. It is put into your income and one part of it is reduced, and it can exceed your income and create a loss. So this is important over there. Then we need to come into your MCQ first part concepts. It talks about agriculture income, section 21A. I'm only giving you the key concepts, the basics, because we are discussing. I'm not taking the entire content and the definitional part of it. Key concept there is the rent or the revenue that is derived from land in India, which is used for agriculture. And it can also be in terms of the revenue that you get from the land. The land should be agriculture land. Again, it can be income from agriculture operations. I've just put as agri operations. So agri operations means it can be even sowing of seeds, tilling, use of fertilizers. So all these are considered as agriculture operations. So what you do over there and get some income, if there is some of these operations done on that agriculture land and you get some income from that, that is also considered as agriculture income. Also income from farmhouses which have been rented and used for agriculture purpose. So here I'm not directly indulging in any agriculture operations, but renting of farmhouses, but that farmhouses are being used for agriculture purpose. So those things also do come over there. Now, along with the basic concepts, the next thing that comes is the residential status. How do you decide the residential status and what is the tax incidence that comes over there? We need to look at this for individuals as well as firms and companies. Basically, individuals and companies is more important. Now, individuals will become resident and ordinarily resident when they actually satisfy any one of the basic conditions, and it is very simple. The basic condition, they must be in India for at least 182 days, in the previous year, and they must be in India for 60 days in the previous year and 365 days in 4 years preceding the previous year. Now, in your MCQ, what becomes important is understand that the basic conditions are referring to period of stay in the previous year. And the additional conditions are talking about period of stay in a period which is preceding the previous year. So the basic condition number 1 and 2, it's saying they must be in India for at least 182 days in the previous year, or it is not and, or being in India for 60 days in the previous year is fine, but you must be in India for 365 days in 4 years preceding the year. So if you are taking into account only 60 days in the previous year, then 365 days in 4 years preceding the previous year is required. Either this condition or the first condition, being in India for at least 182 days in the previous year, is important. Additional conditions, which is resident in India for at least 2 out of 10 years preceding the previous year, and it is not or, and in India for at least 730 days in 7 years preceding the previous year. So these are the additional 2 conditions. Now, if you look at this additional 2 conditions, the first one says being in India in 2 out of 10 years. And the second one says at least 730 days. 730 days means 2 years. In 7 years preceding the previous year. 7 years preceding the previous. So if you take 7 years preceding the previous year and your 730 days in India, it means that obviously you're 2 years in 10 years. I hope you're following what I'm saying. If condition 2 is met, is it necessary to talk about condition 1? I'm talking about the additional conditions. If 2 is met, that means in 7 years preceding the previous year, if somebody is in India for 730 days, obviously in 10 years they will be in India for 2 years. But the difference here lies in the fact that in the first additional condition, they are saying being in India for 2 out of 10 years. There are no days over there. And the second condition, they're talking about 730 days in 7 years. So it is days, not years. There is a difference between 2 years and 730 days. That's what I'm trying to say in your computational part, in your analytical part. What do you mean by 2 years out of 10 years? To meet the 2 years condition, it is sufficient that you have 60 days in 1 year and 365 days in 4 years prior to that. Suppose in 2019, I am in India for 60 days. And in 4 years preceding 2019, that means 15, 16, 17, 18, I have been in India for 365 days. Once again, I am repeating. In 2019-20, I am in India for 60 days. And 15, 16, 16, 17, 17, 18, 18, 19, I am in India for 365 days. Then I am considered to be in India for 1 year in the year 2019-20. But my stay in that year is only 60 days. So when you're saying 2 out of 10 years, this 2 can happen even with 60 days. Or according to condition number 1, it can happen with 182 days. So that's why these 2 conditions have been put together. So what it means, you need to be, the basic conditions, you need to be in India either 182 days in the previous year or 60 days in the previous year, but that should be supported by 365 days in 4 years preceding the previous year. Any one of these basic conditions is sufficient to meet the period of stay in the previous year. And both the additional conditions must be satisfied. If this is done, you are resident and ordinarily resident. You are not ordinarily resident when you are meeting any one of the basic conditions, but you are not meeting both the additional conditions. You might be meeting one, but you're not meeting both. You're either meeting one or you're not not meeting both. So in that case, you are not ordinarily resident. That means you're meeting any one, but additional conditions are not met. Non-resident means you are not meeting the basic conditions itself. So when somebody does not meet the basic condition, they become non-resident. Somebody does not meet the additional condition but meets the basic condition, then they become not ordinary resident. Somebody meets any one of the basic conditions and the additional conditions, they become resident. So resident means meeting any one of the basic, both the additional. Not ordinary resident means any one of the basic, but additional two not met. And when the basic itself is not met, you become non-resident. Clear? I'll come to the implications once again. So I don't know whether this is clear now. Basic, meet any one, meet additional both, you are resident, ordinarily resident. Not ordinary resident, you are meeting any one of the basics, but not meeting both the additionals. Even one, if you meet, there's no meaning in that. Still, you are not ordinarily resident. And basics itself is not met, you are non-resident. This is for an individual. Now, keep in mind, as far as non-residential status, we are talking about how to get the residential status. But for those who are working outside India, that is where tax incidents come. They will be thriving or struggling to get a non-resident status. They are not looking for a residential status. That's why when those who are continuously working outside India, when they come for vacation or when they periodically visit India, they generally ensure that they don't overstay meeting the basic conditions. If they overstay, say for example, condition 1, overstay by 182 days, then they will be termed as resident. So what are they trying to do? They want to get a non-residential status. They don't want to get a residential status because in terms of incidence of tax, if you become a resident, your income that you earn abroad and in India will be taxable in India. So that is a tax implication. So whereas if you are a non-resident, the income that you earn in India will be taxable, but what you get abroad, you can claim as exempted in terms of taxation in India. So this is the tax incidence relating to residential status of individuals. Now, when we talk about firms and AOP, this is how it goes. We look at the control and management of its affairs. If the control and management of its affairs is wholly in India, that it means it is controlled and managed fully from India, then it is resident. If it is wholly from outside India, it is non-resident. And if it is partially in India and partially outside India, even then it is non-resident. So in fact, if you want to have a residential status wholly in India, if it is partially or fully from outside India, it gets a non-residential status. Company, this is how it happens. Indian companies are always resident, in spite of where you manage it, whether it is in India or whether it is abroad, whether it is fully abroad or fully in India or partially in India or partially abroad. If the company is an Indian company, irrespective of where it is managed and where its place of business is, it's always resident. Again, your objective type multiple choice. They might give you examples which are mixed up with companies which have their place in India, which have their place outside India, which are foreign companies. So what do you have to look into once the word Indian company is mentioned? And what do you mean by an Indian company which is registered under the Companies Act? So if it is an Indian company, that word Indian company is used, then wherever be its business, in India or outside India, it is always resident. For foreign companies with turnover greater than 50 crores, turnover or receipts from that, annual turnover receipts from that is greater than 50 crores, then we look into the place of effective management. That's what we mean by point. Place of effective management. If it is in India in the previous year, it will become resident. If it is not in India, it will become non-resident. So this is for those who have greater than 50 crores. But foreign companies with turnover less than 50 crores, they are always non-resident, irrespective of the place of effective management. So this is with regard to the residential status of companies as far as companies are concerned. So as far as companies and firms and AOPs are concerned, they have only resident and non-resident. There is no status or not ordinarily resident. Now, taxation systems, two or three basic concepts are there which you need to get over there. There is something called a flat rate and a progressive rates are there. In India, for individuals, we have progressive rates because we generally follow the socialistic pattern of society. Up to a certain percentage of your income, you pay no tax. Currently 2.5 lakh. Then you pay at a progressive rate, 2.5 lakh to 5 lakh at 5%. 5 lakh to 7.5 lakh at 10%, 7.5 lakh to 10 lakh you pay at 20%, 10 to 12.5 lakh you pay at 15% from 7.5 to 10, then 20% from 10 to 12.5, and 25% from 12.5 to 15 lakh, and then you move up to 30%. So there is a no zero tax rate slab up to 2.5, then 5%, 10%, 15%, 20%, 25%, and 30%. And the new rates, the old rate, it is 5%, 10%, and 20% and 30%. So at least at this stage, we'll come to the rates subsequently. We are following a progressive rate. We are not following a flat rate like the same rate for all slabs. So that is one concept there. Then there is something called average rate of tax and marginal rate of tax. Average rate of tax simply means based on the slabs in which you are, your income tax is computed. Suppose I have 6 lakh rupees as my total income. After all deductions, my taxable income is 6 lakh. Then I compute my tax on 6 lakh. First 2.5, no tax. Then next slab at 5%. So 5 lakh is over. Then 1 lakh at the next rate. I compute my total tax. I take my total tax divided by total income, and that is the average rate of tax. Maximum marginal rate is based on the slabs that you move. What is the maximum taxable rate up to which an SSC can be exposed? An individual can be exposed to a maximum of 30%. So that is what we call the maximum marginal rate of tax. Then again, there is a concept called general rate and a special rate. General rate means taxes imposed as per slabs. Suppose your income is up to 2.5 lakh, you don't pay tax. 2.5 to 5, you pay 5%. So based on the rates, based on the rates that are applicable, your income tax is levied. Special rates, there are some incomes for which, irrespective of whatever your slab is, you'll have to pay a prefixed rate of interest. Now, this happens for incomes like winning from lottery, where you have to pay 30%. Irrespective of whether it is in the first slab, second slab, whatever, the rate is fixed. That's called a special rate. So also for long-term capital gains, there's a special rate. So this is the rates at which taxation can generally happen. Now, some more concepts, I don't know, in the rest of I think a couple of slides more are there, which is not turning out. I don't know. I'll do one thing. The rest of some of the concepts which are remaining as part of this, which we need to actually come back into, I'll just finish those concepts also here. Like when we talk about assessment year and previous year, as far as your MCQ is concerned, normally the income earned in the previous year is subjected to tax in the assessment year. This is what we saw earlier. But then again, for your MCQ net purpose, understand that there are, in most of the things that you study in taxation, there are certain things where we have some exceptions. So here there is an exception to this, and that is something which can come up for your examination. There are certain incomes which, when earned in 1 year, will be subjected to tax in the same year. Normally, income which is earned in the previous year is taxed in the assessment year. But there are some incomes which are earned in the previous year and they are subject to tax in the same year itself. That is because there is a chance that if you give 1 year for them, perhaps that income will escape from the country. So there are, in those cases, the assessing officers can impose taxation in the year in which that income is earned. Now, one or two most important exception. One is for non-resident shipping business. Suppose the assessee is a non-resident operator of ships. Then in that case, they are running ships across a country for either for passengers or for cargo, and there is a chance, and they don't have an agent in India. So it's a non-resident firm doing shipping business without an agent in India. Then if the assessee feels that it is difficult to get the tax from this person in the subsequent year, they may be asked to pay tax in the same year. So also in the case of persons who are leaving the country, they are doing some business and they might leave the country at any time without a what do you call adequate provision for getting tax from the state. They can also be taken as persons from whom you can collect tax in the same year. So there are exceptions to this rule, and this is how it actually uh, goes on. So these exceptions also are things which you need to keep in mind when you look at the taxation structure. Then coming to your basic concepts in headwise, salary. When you look at salary, you have to. I'm stopping with the sharing over here. When you look at salary, what is important is in terms of salaries, you have to look at how allowances are treated, specifically house rent allowance and your fully taxable and partially taxable allowances. Then some allowances are fully, some allowances are taxed only up to a certain level. I'll give you a gist of it and how deductions are adjusted under section 16. There also important are certain perquisites, like most important is house property, how house property is valued, and how what do you call perquisites like car, free gas, water, etc. valued. Similarly, when you come to house property, how you take the gross annual value, and there how you adjust the municipal taxes paid in terms of payment basis, and how you make deductions on an accrual basis. So that's what I said earlier. Certain things are put across in terms of the accrual basis, and certain things are put across in terms of the by and large, it is all on the accrual basis, but there are some specific payments which are adjusted only when they are paid. And that one example is municipal taxes from the gross annual value of house property, which becomes very important over there. Again, in house property, we have to look at the adjustment of interest from house property. Same in the case of profits and gains from business and profession. If you have spent an amount which is exclusively associated with earning income under an head, then that expense can be adjusted from that income. That is what happens in business and profession. But that is not the case with deductions under house property and salary, because there the deduction list is given in an inclusive form. Only that can be adjusted. Say, for example, from salary, suppose I'm saying that I'm a teacher and I have to incur expenses in purchasing books to earn my salary. There is no deduction called purchase of books. But in business income, if I'm saying that I'm doing a business, say in textiles, and to do that business, I have to spend certain amount in terms of doing my textile business, I can, whatever be that expense, if it is attributable to the textile business, I can claim it as a deduction in the profit and loss account. But under salary, the list is just entertainment allowance, standard deduction, professional tax, under 60. You cannot make any other deduction. Same in the case of house property. Same in the case of capital gain, section 54. So that is why in the list that I showed you in the slide that I showed you, you see under salary, no specific deductions. It is not very specific. It is a bit generic. So these are some basic points or some basic concepts which you need to actually keep in mind when you look at the heads of income, which we have to complete or cover later. So what I'll do subsequently is maybe we need to have one more session on heads and one session on assessment part, including tax planning. So if you have, when we get maybe 1 hour more for the heads of income, where I'll be giving you the basic structure and supplemented with the 2 parts on assessment, we'll be able to cover this. So I think with this, I have just finished off with the basic concepts, residential status, as well as agriculture income, which is Unit 10, Part 1 that we have to cover so far. So thank you so much. Now, anybody wants to raise something, or if you want to ask something, you can take this opportunity now. Otherwise, after the, because nothing other than the basic concept has been covered here, but prepare your basic structure. I think you might have heard about this when I talked about the tips. Prepare your that the I have covered several conceptual parts here, like application of income, diversion of income, diverted income, SSE, person, then previous year, assessment year. All those things were covered over there. So on those heads, ARR, MMT, maximum marginal tax rates, all those things, try to get that gist of it, the essence of it. Try to conceive that basic concept. When that basic concept is there, only because you're not, as I said earlier, nobody is going to ask you what are the basic conditions or what are the additional conditions. Nobody is going to ask you, which is the case of diversion, or how do you look at diversion in application. This is all going to be put across through illustrative cases. So you have to identify whether it is diversion of income or whether it is application of income from the given cases. Similarly, and those exactly identifying points is what I have put across here. Similarly, you have to identify whether a person is resident or non-resident. They will not ask you to, unlike your examination, university examination, they might not ask you what are the basic conditions, what are the additional conditions. You have to identify from the days given or from the conditions given, is it a resident or a non-resident? So also in the case of a company, as I said, they might give you an Indian company which is having business abroad and all that. So is it a resident or a non-resident company? Similar to that, or the exceptions from taxing income in the previous year, earned in the previous year, will be taxed in the assessment year. How is there a case which is an exception to that? So on that line, you have to actually prepare. So best wishes for your preparation, and anything which you want to ask, you can take it now from the basic concepts. Otherwise, we will take up this in the next, because within 1 week, we can't have a long gap for taxation. So all the two sessions that I talked about, session 2 and session 3, must take place between at least 4 or 5 days. So accordingly, you contact the Commerce Club, what do you call, organizers will get in touch with you, and within maybe 5-6 days, we should finish this entire unit. So thank you, and over to you. Anything else anybody wants to raise, you can do that.
Okay, good afternoon, everybody. Hope we have come to the end of today's session. So I wish you all had a wonderful time. So now I would like to express our overwhelming gratitude to our resource person, Professor Dr. Gabriel Simon Thattil, to take out time from his busy schedule and to enlighten us on this topic. It was such an illuminating session for all of us, and I would like to express our sincere gratitude towards you, sir. On behalf of Commerce Club, Department of Commerce, and on my own behalf, I express our heartfelt thanks to you, sir. Thank you, sir.
Thank you. Thank you so much. All the best.
Participants are the backbone of every program, and without you, it will not be complete. So I express my sincere thanks to all the participants who has joined. Thank you all. Tomorrow, we will be having a session on logical reasoning at 4 p.m. We'll get you back in the next session. Till then, myself, Arsha Hari, MPhil Scholar, coordinator of today's session, signing off. Thank you.
Thank you. Thank you.